Hey, welcome back to Mr. Market. Thank you so much for joining me. It has been a long time since I made my last episode, and thank you so much for being patient. I had a couple really nice life changes. I recently moved in with my fiance, and as you know, with moving, it can take up all the time in the world. And so that's what I've been doing for the past few weeks, and I'm happy to be back, and I'm ready to go talk about the markets again. So today is a bit of a special episode, not just because I'm back after a long break, but because I wanted to go talk about the results of a live portfolio that I started running last year in July 1st, 2022. I basically put together all the best practices that I learned over my investing career over the past 24 years. And I put it together into an algorithm, and I started off with a portfolio of $250,000, and I started trading based on its signals. And I've used it to go guide me through the market's big ups and big downs over the past year. And so this is not a hypothetical portfolio. This is a live portfolio with real gains, real losses, and real trades. So I think you'll be interested to hear how it actually did. So bottom line, I think this is pretty extraordinary. So over the course of my 24-year career in the markets, this is by far my greatest creation and accomplishment. So from the beginning of July 1, 2022, all the way till June 30, 2023, our strategy returned 1.6 times that of the S&P 500. So we returned 31.79%, while the S&P 500 returned 19.44% over the same time period. But even though we had higher returns than the market, we had significantly lower downside risk than the S&P 500. In fact, our downside risk was 77% lower than the S&P 500, with the market falling a maximum of 16.68%, while our maximum downside was a loss of 3.87%. Our approach had a standard deviation very close to that of a bond market index, so we were able to beat the market but have lower volatility than the market. And we were primarily able to do that by selling options on the market, on the S&P 500, either selling calls or selling puts. And occasionally we were selling calls and puts on individual stocks. But about 90% of the results primarily came from the S&P 500 ETF options. So what this is suggesting is that I'm able to thread the needle and generate high returns, but also have low risk, which in my opinion is the holy grail of investing. And with risk levels this low, it might also be suggesting that I'm taking on too little risk, because by nature, I'm very cautious when it comes to my trading. But if I was to conceivably double my position sizes, I would still have less risk than that of the markets. And so if I had done that, for example, I could have conceivably returned 50 to 60% and still have lower risk than the market. So this gives me a little bit of room, and it tells me that, hey, I'm typically playing it a little bit too safe, and that going forward, I have more room to err on the side of being larger. So if I'm in a situation where I'm on the fence, going forward, I'm going to try to have larger position sizes, because history suggests the strategy can put on a lot more positions without taking on that much more risk. So let's talk a little bit about returns versus risk. And in order to do that, we need to go into some geek terminology and look into something called the Sharpe ratio. Now, the Sharpe ratio is basically the measurement that investment managers use to measure ourselves. You know, it's like when you're playing football, you want to look at the quarterback's quarterback rating. And so the Sharpe ratio is pretty much the investment manager's quarterback rating. The Sharpe ratio is basically the investor's risk penalized return. So that means if you take on more risk, you're going to get penalized for it, and your Sharpe ratio will be lower. So ideally, if you can find someone with a high Sharpe ratio, that means they're generating high returns but have low risk to generate those returns. You know, if you can find someone that has earned 50%, that number in itself is meaningless unless you see what the Sharpe ratio is. Did they earn that 50% taking huge bets? And did their portfolio jump up and down 50 to 60% in any given year? And if that's the case, that kind of volatility will penalize your Sharpe ratio. But if you did it with something that earned you very stable returns, then you'll get rewarded a higher Sharpe ratio. So over the past 10 years, the S&P 500's Sharpe ratio has been about 0.69. And what that means is that roughly the stock market has returned about 10% a year, and its standard deviation, its measure of volatility, has been about 15% a year. So if I was going to put my money on an investment strategy, this is where I would put it personally. And hey, that's what I'm actually doing with my own money. The good thing about this is that it's highly liquid, since all these trades are based on the S&P 500, which is one of the most liquid financial contracts in the world. And also, when you sell options, you're not using your cash balances. In fact, when you're selling options, that cash balance that sits on the sidelines continues to earn interest. So with the Federal Reserve raising interest rates just recently, all it's doing is it's just paying us more for having this cash sitting on the sidelines while we use that as collateral to go sell options and generate even higher returns.
So for this next part, I also wanted to talk about some of the lessons I learned over the past year.
So lesson number one, this is actually probably the most important one, and that is opinions are dangerous things, especially when it runs counter to the market's trends. When you are using a strategy that sells options, time is literally money. And it can take a long time for the market to end up agreeing with whatever your world opinion is. But if that world opinion of yours is something that you're firmly holding on to, you're going to size your bets a lot smaller than you typically should. And it's going to keep you out of many financial opportunities that you could be taking advantage of. And that was one of the mistakes that I learned over the past year. Generally, my results would have been a lot better if I would have just changed my opinion to match that of the market's trend. As for the second lesson, this is actually pretty heretical coming from an investment manager that's got a CFA and has a long history of respecting valuations, and Warren Buffett and that whole school of thought about value being growth over time. And that lesson is valuations, for the most part, don't matter. I know it's a big shock, but what I found is that using valuations as a tactical tool is awful. In fact, valuations aren't very helpful at all in terms of helping gauge where the market's going to be going over the next week or so. And valuations are useful only for trying to gauge how hard the rubber band will snap back in a mean reversion event whenever that snapback happens. But valuations are not useful for predicting when those snapbacks will happen. You can only tell where the valuation extremes are only after the fact, after it has already happened. So I think a lot of talk about the market's valuations, while valid, they do not serve a very good purpose for trading, especially with the strategy that we're using. So I am probably going to not pay as much attention to valuation, even though I have a lot of respect for it. Over the past 20 plus years, it just hasn't been a very good gauge for my timing of entries and exits, and it hasn't improved my profitability. If anything, it has probably kept me out of 5 to 10 times more opportunities than the disasters it has kept me out of. So overall, having too much weight on the valuation metric has been detrimental to my investment performance. Okay, for the next lesson, markets can believe in a far distant reality before it even happens. And it's this transition point where the data don't even match that expectation that the biggest money can be made. So we can see something like this unfolding right now in real time. Back in October when inflation was around 9%, the markets just had a horrible time. But once it started to tick down to the 8s, 8.7, 8.6, that's when the market started to visualize that potential reality that we could eventually get to 2% and hit the Fed's target. When's that going to happen? I don't know. But the most important part is that as long as the data are moving in the right direction, the market can start believing in that endpoint. And while we're not there yet, and while the interest rates still haven't been able to bring down inflation to our target of 2%, the market's already gone up about 28% from the lows since October. And by the time it finally does get to 2%, most of the gains will be behind us. So the key here is to look for, again, not the level, but pay attention to the direction where the data are unfolding. So the biggest lesson here is that the transition periods are where the biggest money can be made, not the final destination. The next lesson is a little bit more tactical, and that is when you're looking to go buy the dips, It usually is more effective when the market is above the 50-day average or above the 200-day average. But when the market is below the 50-day or the 200-day average, dip buying tends to be a little bit more hazardous to your wealth because those dips tend to collapse more. And when the market is below those key moving averages, the 50 and the 200, when the markets do run up, those tend to be better selling points because those gains tend to be given back. The next lesson is a really important one, and that is stick to the fundamentals. Mastery of the fundamentals is the key to greatness. That's what Vince Lombardi said, and who am I to argue with the greatest football coach of all time? So the key here is know how to look at where the support levels are, know how to draw trend lines properly, know how to draw uptrends, know how to draw downtrends, and know where to identify those key support levels, because I've been using that for over 24 years. And by far, those have been some of the biggest factors in the success of my trading. And another key point, you've heard me talk about this time and time again through my past videos. In order to become a great trader, you need to become a good loser. It is so important for every single successful trader out there. They have probably made the transition from being a loser to a winner because of their ability to cut losses and take that punch to the ego and just say, you know what, I'm wrong. I'm going to stop here. Remember, there are two kinds of pain. You will either experience the pain of discipline or the pain of regret. And those people who focus on the pain of discipline live to fight another day, and they avoid those big blowups. And that has been a big key to the success of our trading strategy for the past year. Take that hit when the market goes below your levels. Something is fundamentally wrong with your thesis. And digging in your heels and trying to tune out all the information that can run counter to your thesis is really harmful to your financial well-being. So remember to take those losses. They're there for a reason, and as hard as it is, it's going to be the key to your success and improved profitability. Another lesson is that overbought and oversold signals are totally worthless. I know it's really easy to try to pinpoint those, for every single time that you have a successful overbought or oversold signal, there's probably 5, 6, 7, 8, 9, or 10 of them where it failed. And the thing is, with these signals, I've seen so many failed signals from them that I don't even have it as an input into Algo because they're so worthless. But it is important because it tells me where the rubber band might be at its limits. But the key here is not to look at the level. The key here is to look at the direction. And as long as that market is overbought, we don't know how far it's going to go. But we can put a trend line on it. And once that trend breaks, that's when we can start to act on it. Put a trailing stop on it, whether the market's in a runaway mode to the upside or to the downside. The key is to not so much focus on those overbought, oversold levels. The key is to start putting a trailing stop and looking for when that trend breaks. And so try to be patient and don't let your emotions get the best of you in these situations. So that's all I've got for this week. Thank you so much for joining me. And if you haven't yet, please click like and subscribe so then you can know when my next videos drop. And to go find me, you can reach my YouTube channel at mistermarket.us or mrmarket.us. So thanks again for watching me. Hope you have a good trading week, and I will see you next week.